Welcome back to Marginal Thoughts. Ever feel like the financial world has secrets? It's maybe not sharing.
hmm
What if we told you there's this, like, century-old wealth building strategy? One that millionaires apparently favor, and it's kind of hiding in plain sight.
Yeah, get ready to maybe have some of your financial ideas flipped a bit today.
So let's jump right in. The big question we're tackling is, well, how can life insurance be used to build wealth?
Right. Especially for beginners, people who probably only see it as like a death benefit, something for your family way down the road.
Exactly. That's the common perception, isn't it? Life insurance equals protection for loved ones after you're gone. That's super important, obviously.
Vital. Can't downplay that.
But what if certain types of life insurance could also be real financial assets, assets you can use during your lifetime?
Yeah, almost like another savings vehicle. Maybe something alongside your IRA or your mutual funds, but with different features.
So this isn't just about the death benefit payout.
Not entirely, no. We're talking about permanent life insurance here.
Yeah.
Things like whole life or universal life.
Yeah.
They have this thing called cash value.
Cash value. Okay.
And that's the component that grows over time.
Yeah.
That's where the wealth building potential really lies.
And you mentioned millionaires using this. Is this some kind of like Wall Street secret?
Not exactly a secret, maybe just overlooked by a lot of people. It's definitely not a new thing, though. We're talking generations.
Like who? Any examples?
Well, think about Walt Disney. Story goes he actually tapped into his life insurance cash value at a really crucial moment
No kidding. For what?
to help keep Disneyland going in the early days, apparently. Save the park, some say.
Wow. Okay. That's pretty compelling.
Yeah, and there are others. J.C. Penney, founder of the stores, he used it. Ray Kroc, the McDonald's guy,
McDonald's? Really?
reportedly used his policies almost like his own personal bank, borrowed against them for business stuff.
So kind of like using it as a line of credit?
In a way, yeah.
Yeah.
And even folks like David Walker, a former U.S. Comptroller General, has mentioned max-funded life insurance as a preferred tool.
Max funded. I will have to get into what that means later.
Definitely.
So, okay, these are serious people using this strategy. It's not just theory. But what makes it work? Are they getting like insane investment returns from these policies?
That's the interesting part. It's less about chasing those like pie-in-the-sky high returns.
Oh.
It's more about consistent savings,
Yeah.
the power of compound interest, especially when it's tax-free, and this idea called safe positive leverage.
Okay, safe positive leverage. That sounds potentially complicated for someone new to finance. Let's unpack that.
Right. Let's break it down. Leverage just means using borrowed money, essentially. But safe positive leverage here means controlling an asset, your policy's cash value, without having all your own money tied up directly in it and doing it smartly.
Okay. How do you know if it's smart, though? How do you evaluate it?
Well, there's a good framework, kind of like a test. Some people call it the laser test.
Laser. Okay, I like acronyms. What's it stand for?
So L is for liquidity. How easily can you get to your money if you need it?
Yeah,
Without big penalties, like you might face with early IRA withdrawals.
right. Accessibility. Makes
Yeah.
sense. A.
A is for safety. Is your principal the money you put in safe, protected from market crashes or economic downturns?
Mm.
And crucially, do your annual gains become part of that protected principal?
Okay, safety of principal plus locking in games. That sounds good.
S. Actually, it's E next. Sorry, laser. E is rate of return.
Ah, okay. E, rate of return.
Yeah. Is it earning enough to beat inflation at least? Keep your purchasing power up. It doesn't have to be the highest return ever, especially if the other factors are strong.
Gotcha. And
R is tax treatment. This is a big one. How is the growth taxed? How is the access taxed? Tax-free growth, tax-free access.
Mhm.
It's usually way better than tax-deferred where you pay taxes later.
and life insurance, specifically the permanent kind, passes this laser test.
It can, yeah, especially when structured correctly. The cash value grows, often with guarantees.
Yeah.
You can usually access it via loans. That's the liquidity. The principal is generally safe. The returns compound. And the tax treatment
The tax treatment.
can be really favorable.
Mhm.
Tax-free growth, tax-free access through loans.
Mm-hmm.
It really shines there, passes with flying colors, you could say.
Interesting. Now, earlier you mentioned three marvels of wealth accumulation. Sounds intriguing. How does life insurance fit into those?
Right, okay, marvel number one, compound interest.
The eighth wonder of the world. Right.
Yeah.
Einstein.
That's the one. But Rothschild supposedly added a twist.
Mm.
The real wonder is tax-free compounding.
Tax-free compounding. Why is that so much better?
Well, think of it like engines. Tax-deferred growth, like in a typical 401k or IRA, that's like a good, solid propeller engine. It gets you there.
Okay.
But tax-free growth. Like you can get inside a properly structured life insurance policy. That's like a jet engine. Same principle, compounding, but without taxes constantly dragging down your returns each year. Much faster growth potential over the long haul.
A jet engine versus a propeller. I like that visual. Okay, what's Marvel number 2?
Safe, positive leverage. We touched on this.
Right, controlling assets without tying up all your cash, safely.
Exactly. A lot of people think interest is always bad, like a drag on your finances.
Yeah, paying interest isn't usually seen as a good thing.
But think about wealthy individuals or big businesses. Does Donald Trump pay cash for a skyscraper?
Probably not.
Right. He mortgages it. He borrows money, pays interest, but expects the building's value or income to grow faster than the interest cost. That's leverage.
Okay, so how does that work with life insurance again?
So you build up cash value in your policy. Maybe it's earning, let's say, 5 or 6% tax-free compounding over time. Then you can borrow against that cash value, maybe at a net cost of, say, 4 or 5% after considering potential tax deductions if applicable, or just the stated loan rate.
So you're borrowing at 5% while your money inside is still earning 6%.
Potentially, yes. Or maybe the policy earns dividends on top of guarantees. The point is, your money inside the policy keeps compounding, even while you've borrowed against it and are using that borrowed money elsewhere, maybe for a business or real estate or college tuition.
So you're earning a positive spread. That's the positive leverage. And it's safe because the loan is secured by your policy's own cash value.
Precisely. Your underlying asset continues to grow.
And this leads to the third marvel.
Kind of implied, yeah.
Yeah.
It's this concept of becoming your own banker.
Okay, explain that.
Savvy people often keep their serious cash reserves, so the liquid savings, inside these max-funded life insurance contracts.
Max funded again? What does that mean quickly?
It means putting in the most premium the IRS allows relative to the minimum death benefit. This basically turns the policy into a supercharged savings vehicle, a tax-free cash cow, rather than focusing purely on the death benefit amount.
Got it. More focus on cash growth, less on just the death payout.
Exactly. Done right, the money inside can potentially double every, say, 7 to 10 years tax-free.
Wow.
And because you have that cash value, you can then borrow against it for those other opportunities we mentioned. You become your own source of financing, basically. No bank applications, no credit checks usually required by the insurance company for a policy loan.
Your own private financing pool that keeps growing. That's a powerful idea.
It really can be.
Okay, so for listeners, especially beginners, it's super important we reiterate, this isn't all life insurance, right?
Absolutely. Critical point. This wealth building potential we're discussing, it really only applies to permanent life insurance.
Not term life insurance.
Correct. Term life is pure protection. You pay your premium, you get coverage for a set term, 10, 20, 30 years. If you pass away during the term, your family gets the payout. If the term ends, the coverage stops. There's no cash value buildup.
It's generally cheaper initially, though.
Yes, because you're only paying for the death benefit risk for that period. But it doesn't build this asset component we're focused on today.
So we need permanent life. What are the main types there for asset building? You mentioned whole life and universal life.
Right. Whole life is probably the most traditional. It combines the death benefit with that cash value savings component. Part of your premium goes to the insurance cost, part goes into the cash value.
And the cash value.
It grows at a guaranteed minimum rate set by the company, plus potentially more through dividends, which we can talk about. And typically, your premium stays level for your whole life.
Okay, level premium, guaranteed growth, potential dividends. What about universal life?
Similar idea, death benefit plus cash value growth. You can borrow against it. But there's more flexibility, which can be good or bad. Premiums aren't necessarily fixed. You might be able to adjust them within limits.
And the growth.
The interest rate credited to the cash value often isn't guaranteed like in whole life. It might be tied to current market interest rates, so it could go up or down.
More potential upside maybe, but less certainty?
Kinda, yeah. And then there's variable universal life.
Variable.
That lets you take the cash value and actually invest it in sub-accounts, kind of like mutual funds, inside the policy.
So potential for even higher returns, but also market risk.
Exactly. You could potentially lose value if the investments perform poorly. It adds another layer of complexity and risk.
Okay, so focusing on, say, whole life or maybe a standard universal life. You've got this cash value growing. How do you actually use it during your lifetime?
Several ways. The most common for this strategy is taking a loan against the cash value.
From the insurance company itself.
Yep. They charge you interest, of course. And any loan balance outstanding when you pass away reduces the death benefit paid to your heirs.
Makes sense.
What else?
You could use the policy as collateral to get a loan from a bank. Having that cash value as security might help you get approved or get a better rate.
Okay. Can you just take the money out? Like a withdrawal?
You can, yes, make withdrawals. But there are potential tax implications there. If you withdraw more than the total premiums you've paid in your basis, the gains could be taxed as income.
Ah, so loans are often preferred for tax reasons.
Often, yes, because loans against the policy generally aren't considered taxable income. Withdrawals also permanently reduce your cash value and death benefit, whereas loans can be repaid.
Got it. Any other ways?
Well, some policies have accelerated benefits. If you get seriously ill, like a terminal diagnosis, you might be able to access a portion of the death benefit while you're still alive.
For medical costs and stuff.
Right. And the last resort really is surrendering the policy.
Just cashing it out completely. Yeah. Canceling the coverage and taking the accumulated cash value minus any surrender charges or outstanding loans. You might owe taxes on the gains, and obviously you lose the death benefit protection entirely. Not usually ideal if the goal is long-term wealth building and protection.
Okay, so loans seem to be a key way to tap into the value while keeping the policy going. This ties back to that infinite banking or becoming your own banker idea, doesn't it?
Exactly. Instead of going to a bank for a loan for, say, a down payment on a property or finding a business venture,
You go to your policy.
you borrow from yourself, essentially, from the pool of capital you've built inside your life insurance. The interest rate might be competitive or even lower than a bank's.
And no lengthy applications or credit checks from the insurer.
Generally not for a standard policy loan, no. It's your money, secured by the policy itself. There's flexibility in repayment, too, though it's usually wise to repay the loan to maintain the policy's full value and benefits.
It really puts the control back in your hands.
That's a big part of the appeal. It embodies that safe, positive leverage concept.
Let's circle back to whole life specifically for a moment. What makes it particularly suited for this, for someone wanting steady wealth building?
Well, you've got that tax-deferred cash value growth we mentioned. That's huge.
Right, the jet engine.
Kinda, yeah. Plus, the guaranteed minimum return, often around 4% compounded in many policies today. That provides a baseline level of safety and predictability.
And dividends, you mentioned those.
Right. Many whole life policies from mutual insurance companies are eligible for dividends. These aren't guaranteed. They depend on the company's performance.
But if they are paid, what can you do with them?
Lots of options. Take them in cash, use them to reduce your premiums, let them sit and earn interest, pay back policy loans, or, and this is powerful for growth, use them to buy paid-up additions.
Paid-up additions, what are those?
Think of them as little, mini, fully paid-up whole-life policies that get added to your main policy each year you use dividends this way. Each one has its own cash value and its own death benefit.
So they turbocharge the growth?
They really can, yeah. They accelerate both the cash value accumulation and the total death benefit over time. It's a key way to make the policy work harder for you.
Okay, this all sounds, well, pretty good. Maybe even too good to be true for some listeners. What are the catches, the misconceptions, the pitfalls beginners need to watch out for?
Definitely things to be aware of. A big misconception, as we said, is just thinking it's only death insurance. The reality is the living benefits, the cash value growth, can be a major part of it.
And the idea that term is always better.
Yeah, that's another one. Term is pure protection, great for temporary needs. Whole life or permanent life offers that asset component. They serve different purposes. You might even need both at different times.
What mistakes do people make when trying to use this strategy?
A huge one is buying the wrong kind of policy or structuring it poorly. Buying a policy designed purely for the maximum death benefit for the lowest initial premium that often won't build cash value efficiently. You need one designed for cash accumulation if that's your goal.
So focusing on that max funded idea we talked about.
Right, or at least prioritizing cash value growth in the design. Another mistake is quitting too soon.
Why is that?
Cash value growth, especially in the early years, can be slow. There are costs and commissions up front. These policies are designed for the long term. Surrendering in the first 5, 10, even 15 years might mean you get back less than you paid in.
Patience is key then.
Absolutely.
Oh.
Also, not repaying policy loans. While flexible, consistently borrowing and not repaying depletes the asset and the death benefit. It undermines the whole strategy.
And finding the right advisor.
Crucial. You need someone who understands these concepts, listens to your goals, whether it's cash value focus or something else, and designs the policy for you, not just for their commission.
Okay. What about the downsides of whole life itself? It sounds like premiums might be higher.
They generally are, yes.
Yeah.
Significantly higher than term insurance for the same initial death benefit. That's because you're funding the lifelong coverage and that cash value growth. If your budget is tight or your income fluctuates, committing to those premiums can be tough.
So affordability is a real consideration.
Definitely. Policies can also feel complex. Lots of rules about accessing cash value, dividends, loans. It's not as simple as maybe a savings account.
Yeah.
Less flexible than some other investments, perhaps.
And the returns, we said they're not necessarily sky high.
Right. The cash value growth, while often guaranteed to some extent and tax advantaged, might be lower than what you could potentially get from, say, investing aggressively in the stock market over the long run.
So there's a trade-off.
Always. With whole life used this way, you're often trading potentially higher, more volatile returns for safety, guarantees, tax advantages, and that unique access via loans.
So wrapping this up for someone just learning about this, what's the main thing you want them to take away?
I think the biggest takeaway is just to broaden your perspective on life insurance. Understand that certain types, especially whole life, when structured and used the right way, they can be much more than just a payout when you die.
They can be active tools.
Exactly.
Right.
A savings vehicle, a source of loans, a way to build long-term tax-advantaged wealth. It's a financial tool with unique characteristics that might deserve a place in your overall plan, even if you're just starting to build one.
Well, we hope this conversation has shed some light on a different angle of life insurance, maybe one you hadn't considered before.
Yeah, it's definitely not the typical dinner table conversation about insurance.
True. What are your thoughts? Have you ever considered using life insurance this way? Or maybe you already are. Let us know your experiences, your questions down in the comments.
We'd love to hear from you.
And if you found this interesting, maybe a little eye-opening, be sure to subscribe to Marginal Thoughts. We're always exploring these kinds of less talked about financial ideas.
Absolutely.
So here's a final thought to leave you with. Could an asset that most people only associate with the very end of life actually be a key to unlocking more financial freedom and opportunity during your life? Think about that.